Good morning. Thank you everyone for joining us today. We're going to give the audience a few more minutes to trickle in before we get started. For everyone joining in, we will be getting started in a few moments. We're just waiting for a few more registrants to join the session. We're going to get started around 10:02 a.m. Okay, welcome back to everyone who joined us in past sessions, and welcome to everyone joining us for the first time. We hope you are all healthy and safe. My name is Camila Masson, and I am a research coordinator for the FIU Jorge M. Perez Metropolitan Center, and I'll be one of your co-moderators this morning. Before we begin, I will briefly introduce today's webinar, Hurricane Risks in the Insurance Market. We have some great experts in the field ready to discuss the impact of hurricanes on the insurance market and housing in South Florida. The webinar is being displayed through Zoom's video webinar mode, so panelists will be the only participants featured on the screen, and all attendees will be muted for the duration of the webinar. Attendees will only be able to communicate with the panelists through the chat. Our panelists will also be answering questions from the audience at the end of the session. So if you wish to ask any questions, you can type them in on the Q&A feature on your Zoom window. We will try to get to as many as possible. We are recording this session, and we will be posting the recording on our YouTube page and website. We will also be emailing all participants a copy of today's presentation. Again, thank you so much for joining us today for this very important discussion. At the end of the presentation, I will be moderating the Q&A portion of the webinar. I will now turn the mic over to our Center's Director, Dr. Howard Frank.
Thank you, Camilla. On behalf of my colleagues at the Extreme Events Institute and the Jorge M. Perez Metropolitan Center, I'd like to welcome you to this morning's seminar, Hurricane Risks in the Insurance Market. This morning's seminar covers a subject that has been making headlines since Hurricane Andrew, Florida's ever-increasing cost of property insurance and the risks faced by insurers in providing coverage during a time of climate change and rising costs of reconstruction and reinsurance. These factors pose a constant dilemma for citizens and policymakers, pitting actuarially sound rate setting against affordable coverage and political realities that drive Florida's complex market. My own experience provides a frame for discussion. I've been an owner since 1988. This year, my insurance costs equaled my property taxes for the first time. Next year, premiums will likely overtake the taxes. As a homesteader, the Florida Constitution caps my property tax rate at 3% for the cost of living, whichever is lower. The same cannot be said for property insurance, where high single-digit and double-digit increases have been the norm for years. At some point, I and other owners will face dilemmas regarding insurance costs as a portion of family income. For some, this cost squeeze may lead to limited or no coverage and increased risk of catastrophic costs in the event of windstorm or other damage. This morning's panelists will address the public and private challenges facing Floridians in an extraordinarily complex and fluid environment. Our panelists' expertise covers a wide swath in this arena, and I look forward to their presentations and your questions. Before turning the virtual mic over to my colleague, Eric Salna, Associate Director for Education and Outreach at the Extreme Events Institute at FIU, I'd like to thank Ms. Camilla Masson of the Perez Metropolitan Center in arranging this webinar. And now I turn the mic over to Eric Salna.
Thank you, Dr. Frank. Thank you very much, and good morning, everyone. Pleasure to be here this morning and in this great partnership that we have between the Extreme Events Institute and the Jorge M. Perez Metropolitan Center. So we really want to thank also the panelists for their time being a part of this seminar as well. And for all of you out there that are watching this morning, appreciate you tuning in to this webinar. So first thing we'll do is I'll kind of just read the bios of our panelists here. And our first speaker after me will be Dr. Maria Elcheva, who's the Assistant Director of Planning and Operations of the Jorge M. Perez Metropolitan Center. She serves as subject matter expert in data analytics and behavioral research. And over the last 15 years, she has worked on various economic development, social and behavioral projects, which examine quality of life issues through community indicators such as education, transportation, economic opportunity, and resilience. And after Dr. Elcheva will be Dr. Shahid Hamid. He's a professor and chair of the finance department at Florida International University here in Miami, and also a director of the Laboratory of Insurance, Financial, and Economic Research with the International Hurricane Research Center and the Extreme Events Institute. So he conducts research on the insurance and financial consequences of hurricanes and led the development of a model used extensively by the state of Florida to evaluate homeowner insurance rate filings and conduct the stress tests of companies. And then we also have Robert Warren, who provides both financial and business analysis in the formulation and monitoring of financial stability ratings for property and casualty insurance companies. His knowledge and understanding of insurance business and fundamentals, his expertise in evaluating statutory financial statements, and his ability to review key financial variables bring a valued perspective to Demotech's assessment of the management and stability of its client companies. So that's a quality lineup of panelists for sure on this topic with hurricanes and insurance. So I'm going to kick it off here with just kind of looking back, if you will, kind of an overview of the 2020 hurricane season, which was so very, very historical, to kind of set the stage for what we're dealing with when it comes to that hazard and insurance coverage. So Camilla, I'll start sharing my screen here. Okay. All right, make a quick switch on the button up here on the display. All right, looking good, Camilla? All right, thank you. All right, just briefly, my contact information, which we'll be continue to share and you'll have afterwards as well. As Dr. Frank mentioned, I'm the Associate Director with Education and Outreach at the Extreme Events Institute. And you can follow us on Facebook and Twitter. And we are an institute that does a variety of research on different hazards. And some of the things we're involved with then, of course, is Disaster Risk and Resilience in the Americas program, Florida Public Hurricane Loss Model, which we're going to hear from Dr. Hamid more about. And of course, we do storm surge modeling, a model we call CEST. And one more plug here is that we also have another website that we're involved with, and it's the Spanish hurricane website that you can use as a reference later, huracanes.fiu.edu. And that was a great collaboration with the National Hurricane Center. All right, now for the 2020 hurricane season. Here's kind of a snapshot of the storms we had. Just an amazing season. So many names, right? And looking at the numbers from NOAA, just, you know, incredible. 30 named storms, 13 hurricanes, 6 of those were majors. Many, many flights, missions conducted by the hurricane hunters into the storms, and even conducting research and getting data from very interesting underwater hurricane gliders as well. So here are the names that we use. Now, we always have a list of names, right? Well, this year we went from Arthur, all the way through Wilfred, and then what? Well, we ran out of names. We hadn't done that since 2005. And personally, I was hoping to never see this happen again, but unfortunately it did. So the backup for the National Hurricane Center is to then go to the Greek alphabet, which is what we had to do. So we went into Alpha and made it all the way up to Iota, which went farther than what we did back in 2005. So just an amazing year. So looking at the numbers, named storms, hurricanes, and majors, if you look at what is an average season, if you will, well, 12, 6, and 3. 12 named storms, 6 hurricanes, 3 majors. That's an average season. Well, look at 2020, 30. 13 and 6. Now I'm going to talk a little bit now, why did all this happen and what were the variables that came into play that created such a big season? So first thing I have down below in yellow is that we are in an active cycle that lasts about 25 to 30 years. It started back in 1995. And you hear about, you know, the recipe to create a hurricane and the variables that made for a busy hurricane season, but it's not, you don't always hear as much about this ongoing cycle. And research had been done by Dr. Gray at Colorado State University, who's now passed away, but he did, his research showed for various reasons, there's this cycle, 20 to 30 years roughly, where there's many more storms, and then a cycle, it goes into the quieter cycle where there's fewer storms. And so part of what we're seeing is that we are still in this active cycle right now, if you see on the right-hand side, which started back in 1995. Here are the tracks that we saw. And notice we had a lot of tracks come through the Caribbean and into the Gulf of Mexico. And here, this was interesting, I thought, the amount of geography that was affected by at least tropical storm force winds. And you can see a lot of geography was covered this year by those winds. And unfortunately, Louisiana, they were affected a lot with storms coming their way. And I caught this little cartoon I thought was kind of cute, where Texas is showing a level of compassion to Louisiana, since they seem to be the target. So why was that the case? Well, if storms are going to go anywhere, it all has to do with the steering currents. And a big player in that is what's called the Bermuda High out in the Atlantic. And it was, depending on its strength, its size, and its location, that'll determine where storms are going to go. So that was one big playmaker that was positioned just right to keep the storms moving west and funnel into the Gulf of Mexico. And there's other steering currents that get involved as well, but that certainly is a big one. So what was happening this last season? Well, we look at the recipe to create hurricanes, and if you will, and that recipe was there in abundance last year. So first of all, I have things listed here: a moist atmosphere, areas of low pressure, no wind shear at upper levels. Hurricanes don't like that. And certainly we had plenty of warm ocean water. And in addition to that, out in the Pacific, we had a La Nina, not an El Nino, and that affects what happens in the Atlantic. It's interesting, what happens in the Pacific affects the Atlantic hurricane season, and El Nino is when the waters warm up, but La Nina is when they cool down. And that's what we had in place, including a very active West African monsoon season and predominantly low surface air pressures across the Caribbean into the Atlantic. So put it all together, that helped fuel plenty of storms. So switching to now us, the Extreme Events Institute, if you go to our webpage, front and center, we have our hazard risk equation, which we know the insurance industry is very well versed in. And if you look at that, the left-hand side is the end result of the hazard. Is it an emergency, disaster, or catastrophe? On the right-hand side is the H, E, X, and V, H being the hazard, but E, X, and V. EX, the exposure, the amount of people and buildings in harm's way that need to get insured, right? And then vulnerability. How well is that community planned and prepared for a storm, including building codes, which we know we have the strongest in the country here in South Florida. And our big research facility too, many of you may have heard of our Nahiri experimental facility, the Wall of Wind, where we can create up to Category 5 hurricane conditions and test, structures to make them stronger when it comes to hurricane force winds, so there isn't as much damage during a storm. And I'm just going to show you here a video that was a demonstration that we did for a media team. And this video shows what we can do and what we're able to do when we mitigate. And so we created a structure for this media team. They wanted to see damage, but we wanted a teachable moment. And that's what we came up with. So you see our team here getting ready for this demonstration. And there's the structure that we created. And we had it on the turntable. So we had what's called a strong side of the demonstration, where that strong side had roof tie downs and metal shutters. And then we had what was called the weak side, the direct opposite side of the structure, with no roof tie downs and no metal shutters. So we hit the strong side of the strong side of the structure first, and see what would happen. And we got up to, actually just made it up to Category 4 hurricane force winds. And it was reinforced for less than $250. So that right there showed you, we can strengthen a building and we can prevent its damage. Then we spun the building around to that weak side that didn't have the mitigation. And watch what happens. Catastrophic failure. So again, this was, watch that roof, by the way. Amazing how far the roof flew, but just showed you the amount of flying debris that starts flying around during a storm as well. So a very successful demonstration showing you that, mitigation can work and does work. So as we know, when we talk about damage, wind mitigation can save everyone money. $1 spent in mitigation can save at least $6 in damage and cleanup. And one way all of us as homeowners can prevent damage is through a wind mitigation inspection. And some of our panelists may address this a little bit, but all of us can get kind of a scorecard as to what can we do to prevent damage, strengthen our home, and then the hope will be that you will then lower those homeowner premium payments, that it'll become less expensive on the insurance side if you are fully mitigated. All right, and we did a great series on hurricane science mitigation and preparedness, a 12-part series with the Museum of Discovery and Science. It's at mods.org, Eye of the Storm, and we actually have a video in that series on insurance as well. All right, very good. I'll stop sharing here. And we'll, from that, we'll go ahead and get into our first panelist, Dr. Maria Elcheva, and go ahead and take it away.
Thank you, Eric. I have a brief presentation to share as well. And while I'm putting it on the screen, I kind of want to tie it into what Eric was talking about. Our research on hurricane and preparedness and mitigation has been long-standing, actually since the active hurricane seasons of the mid-2000s, 2004 to 2006. And what Eric was talking about in terms of mitigation reminded me of what we were doing back then. If you recall, after these seasons, our state had some mitigation programs in which they gave homeowners grants precisely for the efforts Eric was talking about to improve their homes, to make them more resistant to hurricanes. And what I remember was that within months of these funds being available, they were exhausted, which back then showed how high the demand is, and to a large extent how vulnerable people felt in terms of what they were experiencing as a result of these active seasons. What I will talk about today is some of the findings from our annual hurricane preparedness and resilience poll that we conduct every year in the beginning of the hurricane season. Every year we try to track what we call the culture of preparedness, and any changes, try to glean the reason for any changes in preparedness or intent to mitigate and to decrease vulnerabilities for Floridians. The topic of insurance, as you'll see in some of the results that I show, features quite prominently. And I'll also talk about what we're observing from year to year as a result of its experiences, as a result of the active hurricane seasons in certain years. Before I get to that, then, though, I want to say in just a few sentences that on the macro level, our state and especially the coastal communities are increasingly exposed and vulnerable. I look at it from a population and economic perspective, but in 2014, if you remember, it was covered widely in the news. Florida surpassed New York as the third most populous state. For 2020, actually, the US Census Bureau estimated 21.7 million people were living in Florida, and the state was ranked as the 7th fastest growing, after Idaho, Arizona, Nevada, Utah, Texas, and South Carolina. Since 2000, our population has increased, Florida's population has increased by 6.7 million. Given that increase, though, we still have to talk about that about 20 to 25% of the state remains farmland, which is which implies lower population density. And that means that the population growth obviously has been mostly in the coastal areas. Eric talked a little bit about the science of hurricanes. What it tells us in a very simple way, though, related to climate change, as climate change continues in the same direction, we can see an increase in the number of intense or strong hurricanes in the future. And as a result of the increasing population, which increases our exposure and risk, the projections for physical losses, which you see in the map here, is likely to continue rising. There are certain factors from an economic perspective that increase our community's vulnerability. Housing and economic development, as Dr. Frank mentioned, are a pillar of our research. And these are some of the statistics that we're tracking continuously, not just as it relates to hurricane preparedness and resilience, but from a broader economic development perspective. It shows the change in some important characteristics of our 3 South Florida counties and Hillsborough and Pinellas counties in the Tampa Bay region. So for this time frame, there were some positive economic trends related to rising incomes and housing affordability. Housing costs were rising, but median household incomes, they are not adjusted for inflation, by the way, when I was making the calculations, but it still shows that housing incomes were rising faster than housing costs. And as a result of that, the percentage of cost-burdened households decreased. As a side note, cost-burdened households are those households that pay in excess of 30% of their income on housing and utilities. And this is an important vulnerability factor. The pandemic has likely increased vulnerability, but we will not see that full impact reflected in the data until later this year, when the full 2020 data will be released by official sources. In that relation, our survey data from June 2020, when we collected, we conducted the data collection with 800 coastal county households, shows that the pandemic has changed households' plans on how to respond if a hurricane is threatening their area. 17% indicated it has affected their preparedness because of inability to buy food, medications, pay for housing, or to travel. 1 in 4 households in coastal counties indicated they would never evacuate. Again, I want to emphasize that these are coastal counties, and I would expect that percentage to be lower. And that percentage, by the way, is increasing every year as we've been tracking the data for over a decade, as I mentioned. The trend analysis also shows there is a hurricane effect on preparedness or an uptick in preparedness immediately following a major hurricane. That effect tapers off, especially with the absence of a direct impact in following years. You can see that after a couple of years without a direct hurricane threat, Florida residents reach a certain level of complacency, and even those who have resided in the state at the time of a hurricane threat relax their preparations, relax the perception of vulnerability decreases, and so on. If you look at this chart, it shows 2013 the effect of Sandy, 2017 the effect of Matthew, so an uptick in some of these categories that we're tracking. The 2020 results show the impact of the previous season and the pandemic as well. As I said, data was collected in June, and the pandemic was impacts were visible at that time and are reflected in the responses. The financial strain of homeowners is also showing in several other interesting results. The first graphic here shows that most homeowners are seeing increases in their insurance policies, especially over the 5 to 10 year time frame. 1 in 10 indicated their policies increased by over 10% in the 5 to 10 year period. As a result of increasing rates, we also see a large percentage of homeowners who intend to cancel their insurance policies if their mortgage is paid off. Many would self-insure, meaning that they will put away an emergency fund for repairs to their home, but cost-burdened households are unlikely to have sufficient funds to do that. And as I showed you in my earlier graphic, we have a significant percentage of those in our coastal counties. The second graphic shows the distribution of responses in terms of the factors that affected their home purchase decision. Unsurprisingly, at the top, you see neighborhood, school quality, and price listed most frequently as the top 3 factors. But at the bottom of that chart, flood zone was considered among the top 3 factors by only 1 in 10 respondents, roughly 1 in 11. The insurance rate was a consideration for only 2% of coastal county households. The low percentage choosing flood zone as a factor could be linked to the inadequate assessment of risk. And in that relation, I just want to mention that there is legislation that has been introduced in Congress that would require FEMA to develop a minimum national standard for flood disclosure in communities that participate in the flood insurance program. Florida, even though it's the most flood-prone state in the nation and accounting for about a third of flood insurance policies, has no flood disclosure law at all. Federal policy does currently require lenders to notify borrowers, but only if they're required to have flood insurance based on the location of their home. One other interesting finding from our survey is that about 8% of respondents don't know if they're in a flood zone, and another 12% mistakenly believe they are not, based on the geocoding we did of their location, matching it, the respondent address with the flood maps for the respective area.
2-minute warning.
Perfect timing. I'm ending with just a few general takeaways. Risk factors continue to increase, and fiscal sustainability is lacking at the individual household level for a very large percentage of our households. There will be many households who will be unable to recover on their own, and there will be the expectation for government to step in for financial support, to rebuild, and to subsidize insurance costs. Households' vulnerability and resilience directly impact the macro financial sustainability and vulnerability of government, especially local government. There has been, we are seeing in our research an increased use of general obligation bonds to fund resilience projects, but little has been invested, or there has been little investment to bolster citizens' resilience, financial, social, and even talking about physical structures. Coastal projects protect assets, but not necessarily the inhabitants. And the last point that I want to make, and that's certainly part of our research agenda as we try to improve public policy and provide data and evidence for that will drive public policy, is that we need to build economic resilience and to improve our ability to invest in mitigation at the individual level. We cannot expect that government will be able to step in, but we should be focused on improving economic opportunities, raising incomes, alongside with making physical improvements to our structures, physical structures and infrastructure as a way to decrease risk and improve resilience. And I will finish here. I believe I'm right on time. Thank you very much for being with us, and I look forward to answering any questions and the ensuing discussion. Thank you.
Maria. Thank you very much. Yes, just a reminder to everyone listening in this morning, go ahead and put your questions there in the Q&A, and we will certainly be leaving time to answer as many questions as we can. All right, next up, Dr. Hamid, you're up next. Take it away.
Dr. Hamid, you're muted.
So I'm going to start by talking a little bit about the exposure the state has and the status of the insurance industry that's affected by this exposure. So Florida has about $3.64 trillion in insured residential commercial properties, 2.16 residential, and pretty much all of them are exposed to hurricane risk. It's ranked number 1 in total property insured and number 2 in coastal property exposed to storm surge, number 1 for hurricane wind. 79% is coastal property. $400 billion in property vulnerable to storm surge, depending on the category. I mean, obviously it's less if it's category 1. When you're talking about category 5, we're talking about $550+ billion exposed to coastal surge. We have 9.1 million homes. About 88% of owner-occupied homes have wind insurance. So about 12% don't. That's kind of higher than the national average, which is about 6.8%. But only 18% have flood insurance. Miami-Dade is probably better than other counties, about 35%, but still below what needs to be. 35% of the flood policies and 35% of the premiums originate in Florida. This is sort of a relative exposure relative to the other states. New York has more exposure, Texas has more exposure, but we are, in percentage terms, coastal especially, number 1. The amount of premium that's earned in is pretty good. I mean, it's a lucrative market. Homeowners, 10.1 billion per year, commercial, 25.5 billion, autos about 20.7, and flood, about 1.78 billion. And these are the top 5 insurance writers for homeowner in Florida, and they're generating pretty good premium. Now, starting with Hurricane Andrew, obviously we've had a major crisis in the personal and residential property market, and it became acute with multiple hurricanes in 2004 and 5. A lot of uncertainty about nature of risk and potential losses, and the insurance and the reinsurance industries. Rates have increased dramatically, adverse impact on, presumably on homeowner business, mortgage at various times. Sometimes it's not a big deal. Sometimes it becomes a big deal after in the aftermath of hurricanes. For a 1990 built home, the average insurance premiums increased something like over 600 and plus percentage between 92 and 2012. In 2006, several polls, obviously that was in the aftermath of the hurricane 2004-5, put homeowner insurance as the second biggest concern. Now, pre-Andrew, we had building codes starting in 1940s, the South Florida building code in Miami area, and Southern building code in the rest of the state, poor compliance enforcement, a lot of different jurisdictions. Pre-Andrew, we had econometric models, and which were, basically premiums were determined actually based on what happened in the last 10 years. We hadn't had hurricanes in the past 10 or 20 years, 1992. So premiums were something like $300 or so for a $300,000 house, the wind portion. And obviously, when you have a major hurricane, you're going to have a dramatic rise. And then over time, if you use that methodology, premiums will go down as time passes by, and then there'll be another hurricane, and you'll have a huge rise. So, a lot of volatility in premiums. So there was a need for a multidisciplinary sort of computer model, physical based, and the FIU has developed such a model in collaboration with 6 other universities. It's called the Florida Public Hurricane Loss Model. It's been used over 1,300 times to regulate premiums, conduct stress tests by insurance companies, and also used by about 30 companies, private companies over time. The South Florida, in the aftermath of Hurricane Andrew, we had the strengthening of the building code, South Florida Building Code 2002. Was a statewide building code. It superseded the local codes. Local jurisdiction can still, or counties and so on, have codes, in local codes, but they have to be stricter. The code is updated every 3 years, the strongest in the US. One of the pushback against the codes was that is going to increase the housing costs and reduce affordability substantially, but studies have shown, and kind of surprisingly, that the housing cost really increased only 1 to 10%, mostly 1 to 5%. So it really didn't have a big impact. Second, we have in the aftermath of Hurricane Andrew, Florida Cat Fund, $17 billion payout capacity plus emergency assessment, and probably they can get authorization for additional borrowing capacity. You have the Citizens Property Insurance Corporation, which has become more like a private, it used to be the insurers of the last resort. And then Florida Commission Hurricane Loss Projection Methodology was established. Basically, it set up methods for reviewing and certifying loss models and helping with the rate filing process and so on. Some of the output that we have from our model, probability of, for example, no hurricane is 60%, 3 hurricanes as in 2004-5 and something like 2.8%. Some of our results, the average annual loss is some zero deductible, about 4.7 billion, net of deductible 3 billion. So deductibles have reduced the losses or expected losses to the insurance industry substantially. PML, probable maximum loss, 100 years, 51 billion. I think we're a bit conservative compared to some of the other modelers. We have done scenario analysis. What if hurricanes were to landfall 90 degrees to the coast in different locations, such as Jacksonville, Tampa, Miami, and Panama City, and so on. We basically, if you have a category 1, this is based on older exposure, I guess 2007 exposure, but give you an idea. The zero deductible loss for Jackson will be, sorry, apologize for this noise. I hope you can still hear me. Out of my control. 1.8 billion, whereas the category 5 is 16.2 billion. The net of deductible is 0.4 and 14 respectively. So you have a 78% reduction because of the deductibles that's borne by the homeowners when it's category 1, about 14% when it's category 5. In Miami, on the other hand, you have a 55% borne by homeowners for category 1, 16.5% for category 5. The highest, these are similar, exactly the same hurricanes going through, these different locations. And Tampa happens to be the most vulnerable in the sense that, if something is landfalling 90 degrees, it's going to go through Tampa and probably Orlando and hit the East Coast also. And so there, the estimate is something like 50 billion, as opposed to 31 for Miami. I mean, you're going west in you're basically hitting the Everglades. So how much of the cost is borne by percentage-wise by homeowners who then need probably help? It depends on what category of hurricane it is, and it can be substantial for lower categories. Some of the estimates that we have, if we hurricane were to occur again, and these are only for personal residential policies, and our estimates are probably lower than some of the other estimates I've seen, but nevertheless, they're substantial under the current. This is what I call the mother of all hurricanes. You have a Cat 5 large hurricane coming from the south, going through Miami, and then slightly inland, so it affects Orlando also. And the right side is, most damaging side is right on the coast. Our estimate is about $147 billion. And the insured part, the total loss is obviously 2 or 3 times more. Mitigation is obviously the best way to reduce losses and premium costs. And some of the estimates that we have from the model, along with some research that was done in Wall of Wind, these are the percentage of losses that can be reduced by having, for example, AD nails, if you nail the roofs properly, by having a stronger roof-to-wall connection, you could have substantial reduction in losses and shutters and so on. And you can achieve something like 40% reduction through these mitigation features alone. And these are some of the we have how much reduction you can get in damage with the wind speeds. So the blue line up on the top is unmitigated, and when you have all the mitigation, you have the lowest one. And these are basically for different versions: weakly built, medium built, and strongly built, and so on.
2-minute warning, Shahid.
Okay, so the bottom line is these are the consequences of the mitigation. You have 1992 built home, 13,500 is for 300,000 is the premium. If you mitigate it, the same house, 6,500. If it's built under the new code, 5,000. You get a substantial reduction in premium. One of the important lessons from the past experience is that, and our model in the Wall of Wind has demonstrated, is the roof-to-wall and roof is the most vulnerable feature. And even though you have had substantial improvement in the building code, but wooden roofs are not really suitable for hurricane-prone areas. We need to switch to concrete roof. I mean, slope wooden roofs and tiles with tiles are architecturally beautiful but vulnerable. Cheap slope concrete roofs have been developed to bear wind loads, but they're not selling. But we need to really switch to this thing. I was going to talk about flood insurance, but I'll skip that. Some of the issues that are faced by insurance industries, big one is law and ordinance, very quickly. These are indirectly or directly related to disasters that happened in the past. If the house is more than X percent damaged, 50%, it must be demolished to build up to the current code. More than 50% windows, you have to replace and build it up to code. This increases the repair cost and demolition cost. We also have the issue of flood versus wind, because you have 18%. This should be actually more like 88% of homes have wind insurance, 18 have flood insurance. So when you have when the hurricane comes through, a lot of policyholders with flood insurance, with wind insurance, but no flood insurance, when they have water damage, they claim that it's really through wind, because if water comes in through some kind of from the roof or hole in the roof or windows, something, it's still covered by the wind policy. So this has become a huge problem, resulting in thousands of lawsuits, and it's something that's models are struggling to cope with. And then, of course, you have the assignment of benefit problem, which results in frauds and so on, allows policyholders to give permission to contractors, adjusters to bill insurance companies and settle them. It's like the contractors are now policyholders. They can create abuse and fraud, unnecessary repairs, resulting in insurance crisis. The point is that insurance premiums went up dramatically, and then they kind of plateaued for a while, and then they've started going up a lot. And part of it is because of these issues that I just mentioned, which are indirectly related to past disaster. Thank you.
Thank you, Shahid. Great job. I always focus sometimes too, there's that one slide you show, and it's with all the runs of that model and all the different tracks. What would be the worst case scenario track causing the most, damage and cost? And it's a south to north moving track. And that track was on the table, if you will,
yes,
with Hurricane Irma back in 2017. And for a while, we were looking at that scenario, which you don't always see a storm move from south to north like Irma did, but that one had the opportunity, the possibility to do that, but we saw how the track shifted more to the west and came through the key.
Yes, the paying capacity in Florida is 60 billion. That track would have literally put the industry under.
Yeah, put the industry
We were fortunate.
under. Yeah, how close we were with that track and that storm. Well, thank you again. All right, next up we have Robert Warren, and go ahead, take it away.
Good morning, everyone. Thank you for the introduction. I've heard a lot of good comments this morning, and a lot of it reinforces what Demotech deals in almost on a daily basis when we're evaluating and reviewing private carriers that are providing the peril of wind in the state of Florida. I don't seem to be able to advance my slide.
Robert, kind of hover your mouse over towards the bottom of your screen. You may see like little arrows and stuff pop up. Then you can hit your space bar, possibly.
Yeah, I don't see anything. I'm stuck here. That's unfortunate.
If you have the controls, Robert, on your second screen, you can click them from the second screen. Like if you see the arrows on the second screen.
Okay, there we go. Sorry for the interruption, folks. A lot of this will be supporting what you've already heard this morning. One of the things I wanted to touch on quickly were the 2020 results. And here we're talking about a group of 50 companies that Demotech currently rates, who are primarily writing the peril of wind in Florida. There were significant underwriting losses. Much of it was attributed to the number of storm events that you've already heard about that were presented. I think Eric touched on most of these things. I won't go over that in detail, but just to give you some perspective, just the companies that we provide a rating for, we're talking about in the neighborhood of $600–700 million in underwriting losses. That's obviously pre-tax. That's just the insurance business portion of their financial results, but it is significant. One thing you need to keep in mind when you saw some of the mapping of the storms throughout the Southwest and maybe a little bit of the Southeast United States for 2020, a lot of the companies that started out writing primarily in Florida or solely in the state of Florida undertook some geographic diversification in the last 4 or 5 years. So lo and behold, they went from Florida to Louisiana to write in addition to Florida. Well, that wasn't such a good move in 2020, as you could see. So it's significant because the health of the private insurance carrier market in Florida is significant to what's going on here. Multiple weather events, we've already covered a lot of this. This is not just hurricane focused for a lot of these players. There were a lot of convective thunderstorm activity. They're called mini cats or they're unnamed cats, whatever you want to call them. But in a lot of cases, they're from the ground up losses that are absorbed by these companies that are not handed over to the reinsurance market. That was a significant number in late 2019, early 2020. Claim settlement practices, you also heard people touch on these things. The reality is this is not just about hurricane losses impacting these results or even convective thunderstorms that are more localized. The last 5, 7, 10-year period in Florida, there's been a number of items with respect to claim settlement practices. Assignment of benefits is obviously one that everyone's familiar with. Even though there were legislative activities that took place last year to address this, it's not wholly it's not been wholly addressed at this point. These companies are still struggling with assignment of benefits practices. Prior to that, it was wind mitigation credits. Prior to that, we had sinkhole exposure, any number of things. And I just had a call with a CFO, or excuse me, a CEO of a company that we rate recently that was talking about claims that they're handling that are addressing cracks and fissures in the stucco and the exterior walls of houses. So that may be the next fiasco that we're dealing with. The other issue is, and we've touched on this as well this morning, Irma would be a good example of a storm that could have been probably a much worse event from a severity issue, but it wound up being frequency. And what these companies are dealing with is there are situations where up until October of this year, they were still getting first notice of loss on Irma claims. That means that those claims were 36 months in the making, which is unheard of. And those types of things create long-tail development on a cat event that the reinsurance industry, the carriers, everyone involved doesn't know how to address that in their pricing, in their territories and things of that nature. It really makes it difficult. The name of the game in Florida for a lot of these companies, even the much larger national players, is reinsurance. We spend an inordinate amount of time at Demotech looking at the reinsurance programs that these companies have in place and the risk-adjusted rates. So that takes into consideration the changes in their program from one renewal period to the next, all those types of things, has been going up dramatically the last couple of years. I think most of these players were experiencing 15 to 20% increases in their overall catastrophe reinsurance programs. Now we look at how much premium is ceded for this group, comparing one calendar year to the next. 2019 over 2018, these companies ceded premium went up 25%. So that is significant in and of itself. And when you consider the base, these companies are paying the reinsurers north of 60% of every dollar they take in for catastrophe reinsurance coverage. That's significant. Does not leave a lot of room for profit margin on these for these carriers. The flexibility and features decreasing. It's not just an issue of, you know, the program's going to go through renewal. The cat reinsurance program is going to meet our requirements, our stringent requirements, as well as the regulatory requirements. So what happens is, and this is typical in any market situation, yeah, it's still available to you out there, but it's more expensive. And oh, by the way, the programs aren't as flexible. And the features that they normally would offer, like cascading, where you can use cover for one event. If you don't use it all, it drops down to the second or third or fourth event scenarios. Those types of features have been withdrawn by the reinsurers. And so it's not just an issue of, hey, these companies are paying more for this, but some of these features and the flexibility of these programs is drying up as well at the same time. The accelerated rates and lower attachment points, those are significant in the reinsurance world. A lot of these reinsurance towers, when you look at them for a particular event, the lower level coverages from ground zero to the first 5 million, for example, for a carrier to reinsure that is very expensive for obvious reasons. There's much more propensity for them to use those lower layers. And so it's not just the overall cost within that tower is accelerating, it's getting more expensive at these lower levels. And so that becomes problematic for these carriers as well. Lower attachment points, Obviously, if it's more expensive, there's pressure on these companies to retain more of the loss, first dollar loss, and that becomes even more expensive. There were situations where we were looking at retention points for these companies, and they were literally spending $1.20 for $1 worth of reinsurance coverage. But they have to have it because they need to qualify at certain levels for our requirements to maintain a rating, but then also it's a regulatory issues and other things. So it becomes kind of problematic here. The reinsurance cost and availability, it can spend more time on that. But we've also talked a little bit about the Florida Hurricane Cat Fund and its participation in this. We give full credit in our ratings process for the Florida Hurricane Cat Fund. And if you think back to maybe 2008, during the credit market crisis, it was very difficult for us to do that because it called into question the Florida Hurricane Cat Fund's ability to go out and generate additional capital to pay these claims. So it's 17 billion to 30 billion. They don't have all of that liquidity sitting there in the Florida Hurricane Cat Fund. It's going to take assessments. They've got some on-the-shelf bonds that have been issued that are available to them. All those things are important. But the reinsurance cost and availability is something we're looking at constantly. I think you're all aware that the ILS or the cat bond market with really private investors coming in has made a big difference the last couple of years. Now, having said that, they've also experienced some losses in those cat bonds, and that freezes that liquidity for those investors. So that becomes negative in terms of an investor. You can't get access to your funds until this thing completely settles out. So that's impacted the rates or the cost of those cat bonds for these companies. It's a significant issue. We believe the reinsurance is going to be available and continue to be available to these client companies in Florida, but it's going to come at a cost. It's going to be more expensive for first dollar coverage. The ILS market is still strong. There's still capital that will be available there, but it's going to probably be more expensive for some of these players. And when you look at 2020, and even with the amount of money that these companies retained in these losses for weather events on their own, it's going to be more expensive going forward for Florida. As I mentioned, a lot of these players have expanded beyond Florida. They're in Texas, Louisiana, Alabama, Georgia, the Carolinas. Those areas haven't avoided weather events either. So it's going to be a collective.
Warning, Robert.
Thank you.
Yep.
Claims practices. I don't know how much more time to spend on this because we've talked about the assignment of benefits, the other issues. Can you do something legislatively to help this? You probably can. Now we're in a cycle where I hear a lot of companies and a lot of policyholders talking about roofing contractors in a neighborhood going through, the entire roof is replaced. It's a $50,000, $60,000, $70,000 item that wasn't necessary. The assignment of benefits practices is well documented. Case studies that are found not favorable of these companies, their ability to work with this. These primary carriers, as far as the state of Florida is concerned, and your everyday policyholder or homeowner, these primary carriers are jettisoning business. Citizens went from 1.5 million policyholders several years ago down to 400,000. A lot of effort was made to focus on this, to get this business in the hands of these private carriers where it belongs. We're looking at Citizens probably expanding at a rapid pace here over the next calendar year or so, which is not good because that's simply a mechanism for passing these losses on to, the population of homeowners in the state of Florida. So is there one single silver bullet solution here to, homeowner rates increasing 20–30%. That's probably part of the solution. It's not, obviously not the entire solution. Is it legislative activities? Yes, that's going to be a piece of it. Reduction of attorneys' fees on a multiplier basis. There are several points out there that you could address that would improve the environment for Florida for these primary carriers, which would cycle through to the reinsurance industry, which in turn ultimately helps out the policyholders and makes this more affordable. There are private flood carriers out there right now. I don't know if that's the solution to the flood issue, but the amount of flood policies in place clearly needs to be increased in the state of Florida. A lot of people don't understand it. They already think that water damage is covered under their primary homeowner policy. I don't know how you go about successfully educating everyone on that, but that certainly is one of the challenges that we have. So, in summary, I think it's going to take a collective effort from the companies as well as the legislature and probably other points to bring some correction into this industry in Florida. It's not sustainable as it is in the current model. I can assure you of that. Thank you.
All right, thank you, Robert. Great job. All right, that concludes our panel presentation. So at this point, we can get to some Q&A. So Camilla, how are we doing with some questions?
We are doing good. We have a few questions for our panelists today. The first one is for Dr. Ocheva, and it is, what was the end for the study that you discussed?
If we're talking about the survey results, every year we collect responses from 800 coastal households. So obviously it doesn't cover the central areas or counties that are not along the coastline. But 800 is the number every year.
Okay.
That's a simple question with a simple answer.
Perfect. Our second question is, how much confidence do you have in the PML models currently used in commercial insurance industry, in the commercial insurance industry? This is for all of our panelists.
If you're referring to the CAT models, actually, Warren may be able to, since he's presumably one of the users or familiar with the model, maybe you can start with that.
Yeah, I think the issue that we face, we do data calls to all of these companies, not just Florida, but also those that are writing coastal exposure that are relying on these models. And the first thing you'll hear people say in general terms is, the only thing you know for sure about these models is they're not correct. Well, that's fine, but you need some base, something to go on here, because prior to Andrew and most of the failures from those companies in that time frame, woefully inadequate reinsurance. And so Demotech, if we're going to sign off on the financial stability of these companies writing this wind, they have to demonstrate that they're using these models. They give us or provide us detail on our data call, what models they're using, what secondary modifiers are in place, what they've done in terms of their data quality, because garbage in, garbage out, it's just like everything else. If they don't have sophisticated data from that policy information, those models are not going to be effective. And so we even go through the process of looking at what the standard PML is generated from a model versus, okay, show us management's version, which includes secondary modifiers. the construction and the age of the homes, the type of roofs, all that information's involved. The modeling effort, and we stay in touch and we have contact several times a year with representatives from these various modeling agencies. And so we're pretty familiar with it. We're not technical experts, but we like to think we can at least look at those models and do they make sense? The other critical piece, in my opinion, at least, is you collect that data over a period of time. You look at the exposure base of the insurance company. You compare from one renewal to the next what their PML looks like. If their PML went down 10% and their policy exposure base and their total insured value goes up 20%, something's probably amiss there. So you're going to go ask questions. But the reality is these models aren't perfect, but they're certainly the best thing we have. And on an annual basis, I think they've made significant improvement in their ability to quantify some of these events and things. A lot of people want to rely on it and say, this 100-year PML, if I buy reinsurance coverage to this, to XYZ, and we have a quote 100-year event, this company's going to survive. I think the reality is, and we specifically ask CFOs and CEOs of companies, the last question I ask them when we do the review of their cat reinsurance is, what terrifies you with respect to a hurricane? What's the fatal blow? Cat 5 hits Tri-County. Yeah, that's probably going to be a very significant issue for the industry. Something less than that, these companies are going to survive just like they did this year. That's what reinsurance is for. And it works the way it is supposed to work. In Florida, if you can correct some of the non-storm event activity, like assignment of benefits and multiply your fees for attorneys and some of these other things, and get the attritional or the non-cat loss ratios back into perspective where they belong, which would be maybe 20% or less, that would be a huge step forward. They can absorb these storm events, but when you're layering on top of that all of this other claims activity that's not been considered or built into their pricing mechanism, that's what's causing a lot of pain as well. But the models are viable. They're the best tools we have right now, and Demotech's evaluation process, we are certainly looking at the output of these models for these companies.
I should like to add that the certified models by the commission go through very rigorous examination, and they have something like 35 different standards they have to meet in various fields: computer science, engineering, vulnerability, metrology, and so on and so on. But the limitation of the model is the model themselves actually can produce better results. The problem, as Bob said, is the input data that we get. A lot of times the input data is very much incomplete. We'd like to get information on what type of roof each house has. The best we get is the year built, and maybe it's masonry or frame, and that's it. We don't get the square footage. We don't get whether it's 1-story or 2-story, and whether it's a gable or hip roof and things like that. It's all these secondary modifiers, in particular, what sort of tiles they have and all that, can really add to the accuracy of our model output. When these input data is not there, we are forced to make some assumptions. We have done survey of county, different counties, to look at the distribution of, for example, using other sources, tax appraisal and other sources, what the wall connection is in what sort of distribution of hip versus gable roof is in any county, and we kind of use some of that statistics to supplement. But that's not going to that's going to create uncertainty. So the point is that insurance companies need to collect more data on the houses that they're insuring and provide that to us to increase the accuracy. You're always going to have uncertainty. You're always going to have inaccuracies, but we can improve it if we have better input data.
Yes, and I would also add that as far as the modeling efforts are concerned, a lot of these companies have taken the step the last couple of years, it's really portfolio maximization. So what they're doing when they get an application for a piece of new business at the homeowner level, they're able to actually introduce that into their current modeling effort. And so they know what the cost of catastrophe reinsurance is on that particular policy before they even write it. And so it's very sensitive. You know, if you can get the roof, the age of the home, the geographic pinpoint location, whether it's GPS or something more than a street or a street address, but if you can get specific geographic location, that also helps. I probably have learned more about the geography of Florida than I ever had planned on knowing 5 or 6 years ago. But I've kind of come to the conclusion that the entire state is basically coastal at this point. The idea that you incrementally determine pricing between a mile of the coast and 2 miles of the coast and those kinds of things, I don't know how viable that is anymore. It's a peninsula 3 feet above sea level. I don't know what to tell you. It's subject to hurricane damage. So there's a cost to protect these carriers. It all boils down to what the reinsurance looks like, what the availability and the cost is. And that's the sensitive side of it. And these reinsurers, believe me, they know exactly what's going on in Florida. They're looking at these companies' pricing models, you know, their limits, their structure. And eventually, the only thing these players are going to be writing or requesting or underwriting will be homes that are under the age of 5 years old in Florida. Well, you know, that's only so many pieces of property. There's a lot of homes out there that need coverage that are well above 5 years old.
Okay, next question, everyone. Effective hurricane mitigation requires building design criteria that goes beyond the minimum requirements of the building code. Factory Mutual Insurance has actively developed code plus standards that result in reduced premiums for their insured. Why is it that the insurance industry as a whole is not proactively following the example?
Bob, can you comment on that?
Yeah, I think the industry itself supports these building codes or these building codes changes. From my chair, I think it's significant. You know, if you've been to Bermuda, for example, I recall the first time I had flown into Bermuda and went through the process of getting from, you know, the landing paddock to the hotel. And it occurred to me that the structures I was looking at were more than 100 years old, and for, you know, just residential property. And the cab driver explained to me that everything's made out of limestone. They're limestone roofs. And so a hurricane passes through Bermuda every year, and there's little to no total damage in terms of these single family personal residences. And the idea is you can build these structures that are, for the most part, going to be minimal damage sustained during a hurricane, even at Cat 5 levels, potentially. But the issue is going from what you have today to that level. That was discovered in Bermuda years and years and years ago. And I believe in the Keys in Florida, a lot of it was just wooden shacks. They expected them to be blown away every 3 or 4 years, and then they just, you know, put inexpensive wooden structures back together. That's all gone now. Obviously, that's not going to work. But the insurance industry is supporting the research. They're supporting tie downs on these roofs, hip roofs. You mentioned the concrete roof structure, the composite materials they've come up with. once you compromise that roof structure, even minimally, that's where the damage comes in, because now you're subject to rain getting in, not necessarily even the wind as an issue. Once you compromise that roof structure, that's where the damage really begins. That's why you see people struggling to get tarps on their roof as quickly as possible. The insurance industry, I can't speak for, maybe some of the lobbying portions of it as far as these building codes are concerned, but certainly it's supported by the industry because it's pretty obvious what these tie downs do, what anchors are for. The shutters can get to be a little expensive depending on what you're doing, the storm shutters and things, but all those are viable solutions to loss mediation through storm events. And the industry supports it. And I'm sure if there were ways to be more active with it, maybe that's what they'll look into. But like I said, as far as I know, the industry's all for that loss mitigation through building codes.
I think the industry is very supportive now, but in the past, when they could pass on the cost to the insurance companies without any problem, they were not as supportive. And it's kind of more of a recent phenomena, but they are supportive now. I think they're funding research and so on. It's basically, they have to give discounts. In the beginning, they were not willing to give the discounts that the models were kind of predicting that would occur, the reduction in losses and so on. And OER had to kind of basically work with them to provide discounts to the homeowners. So Bob is right. I mean, industry is much more supportive now than it used to be.
Wonderful, thank you. Sorry, go ahead, Dr. Flynn.
I just would make the observation, there's the technical aspects of this and the political aspects of it. And I would remind people that after Andrew, when we had incredibly hard evidence of what could happen without appropriate standards, it still took, gentlemen, correct me if I'm wrong, 5-6 years of struggle to beef up the codes after Andrew, and that was when we had quite a smackdown. So I think there's the technical aspect and the political aspect, and I'd also say, and this speaks to Hamid's modeling. You could say that the cost of beefing up and rigorizing structures doesn't cost that much, especially if you're thinking about amortizing it over 10, 20, 30 years. But, the person who won the 2017 Nobel Prize for Economics, he said human beings, his name was Thaler, he said they tend to hyper discount. They don't see the benefits of the future. They only look at the present costs and how much more it will cost to do something. So I think in the abstract, you can talk about making more rigorous building codes, but in practical and economic terms, that may be a tough pill for people to swallow, which is a sad reality, but that's part of the equation here.
Wonderful, thank you, Dr. Frank. So I think we have time for one last question, and it's for Robert and Shahid. How do you think climate change, including coming regulations requiring financial institutions like insurers to incorporate changing climate, are likely to impact the models and their use?
The models don't account for climate change right now. The standards that are there do not allow us to really put long-term. Insurance premiums are determined year-by-year basis. Okay, what's the current condition? What is the prediction? What's going to happen next year, year after that? Not the long-term. So in that sense, the models are not dealing with long-term climate change and those things. But eventually, as things change and the risks change, the risk of sea level rise and become more and more apparent and more quantifiable and so on, then yes, the models will have to take into account. But I can tell you one thing, there's a lot of pushback. For example, I get funding from the state, and I was, I go and make presentations to the legislature, basically, reporting sometimes occasionally about what how the money is being spent and what we're doing with the model and so on. And they always, they used to, not now, but they used to say that we hope you're not incorporating sea level change and rise and all that. We don't want to waste taxpayer money on that. So that, I think, attitude has changed. But basically, the real estate market is, to some degree, already accounting for that. There's some evidence, for example, that the housing price, I'm not sure how good the studies are, but the housing prices in Miami Beach and so on have gone down relative to all things being held constant by 7% relative to what they would have been. But the current rentals have not gone down, and the housing prices are basically present value future rent. So it's accounting for the future. So the current conditions are not, haven't changed. So the rents haven't changed, but the capitalization of future cash flows are going down. So in that sense, yes, the market is to some degree capitalizing the possibility of losses and so on due to future climate change.
Yeah, and I would just to add to that, the only comment that I have as far as Demotech is concerned and looking at these companies and their catastrophe reinsurance issues and things, we're not addressing it, climate change up front necessarily. We appreciate where it is with the models, which is basically non-existent at this point, but what we think will happen is it will catch up eventually, because if climate change is creating a difference in the terms of the severity and frequency of not only hurricanes, but the spin-off storms and things of that nature, it's going to change the outline of the coast, which is going to impact the modeling efforts. Eventually, the modeling will catch up to what the market economy is dictating by the reinsurance industry with respect to Florida. So while they may not be specifically addressing or talking a great deal now about climate change or the impact of climate change, it will come about maybe even from a more of an economic perspective, because the reinsurers are going to recognize what's going on in the state of Florida. If climate change is making these changes, it will be incorporated into these models. And how smoothly that takes place kind of remains to be seen, but there's discussion and awareness out there for climate change, particularly at the international level for the reinsurers. They're very, very tuned into this.
Dr. Ochoa?
I just want to say, from a population perspective, the perception of climate change, that climate change, the belief that climate change and sea level rise are happening is there and has been increasing. That's one of the questions we've asked consistently, and we see an increase in the percentage of Floridians who know it's here. It's not something of the future, but it's the contradictory finding, though, is that even for the households that we surveyed in coastal communities, where you can anticipate that increase and people believing it will impact them, we don't see that. They may see climate change and sea level rises happening, but not necessarily impacting them personally. They still see it in the abstract. It's linked to what I was saying earlier about the perception of risk. I don't think people are aware to the extent we need to make them aware of how it will impact their homes, their livelihoods, their families. And that's also connected to what Dr. Frank and Dr. Hamid were saying about the lack of political will, so to speak. It ultimately comes down to the people themselves not having that push towards our elected officials, the insurance industry, various decision makers to account for it in how we plan for the impending impacts. Thank you.
I think what needs to be done is basically plan for it. Develop contingency plans, have things in place. you don't want to really implement things and put barriers right now. When things will happen 10, 15, 20 years from now, they're just going to rust. So the main thing right now is you have to make some investment in the future, but you don't necessarily need to do everything right now, but you need to have plan. You need to figure out time step, 5 years down, 10 years line, what sort of mitigation measures, how much it will cost, what technology we can use and things like that. You plan for it. It doesn't mean you have to rush and invest, make huge investments.
Wonderful. Thank you all so much. I want to thank all of the participants that joined us today. This concludes our webinar. Thank you so much to all of our wonderful panelists and for the lively discussion that we were able to have today. And I hope everyone has a wonderful day and that everyone enjoyed this wonderful conversation on hurricane risk and the insurance market. Thank you all.
Thank you.
Thank you.
Thank you.